Money Show.
Personal Finance with Warren Ingram.
Now, Warren Ingram is making big promises tonight. He's promising the greatest investment approach ever invented for you as an individual investor. This is the best investment approach ever. Now, that's a big claim. It's a huge claim, and I'm going to quietly cast out my line and let him hang himself on it. Warren, how's this thing that you're about to talk about, the greatest investment approach ever?
Because, well, and just before you report me to the Advertising Standards Authority, it's certainly not claiming that I invented it.
No.
But I do think it is the greatest investment approach ever. And to start with, it's one of the tools that an individual investor has that's not available, for example, to pension funds or unit trusts or any large pools of money where a money manager is making decisions on the one side, and on the other side, that money manager will have clients who are either adding or withdrawing money, and both of those dynamics could be very good and very constructive and generate lots of capital growth for investors, or in bad times, they can be and often are a very bad combination where you've got fund managers making not such great decisions, and then on top of that, clients pulling money out, forcing the fund managers to sell investments, at a time, for example, when they wouldn't necessarily want to, and most of the time having to sell their best and most liquid investments to pay their investors out. And,
okay.
If you're a private
I need an example on this one, Warren. Because as a private investor, you can do something fundamentally different to the lump sum brigade. The people who are forced to put a bunch of money in on day one and then sit with that lump of money for a period of time.
You can, as a private investor, say, I'm going to commit to the most simple thing in the world. I'm going to do a monthly debit order off my bank account. It's going to be automated. It's going to go into my investment every single month on the same day, and I'm not going to think about it again. And I'm just going to keep investing. And I looked for examples of how this works well. And because we're in how do I say this nicely? We're in a rather awful time of global stock markets. I looked for a really terrible time in American markets, because the American market is the one that drives everything around the world in terms of stock markets. And the worst period in American stock market history in terms of growth above inflation, or potentially not beating inflation, was a fairly long period of time, 16 years, from 1966 to 1982. If you had done what I've often spoken about on the show, which is, take your money, put it in the index, and just forget about it. And if you'd done that for this 16-year period, you would have put $1,000 in, and after 16 years, your $1,000 would be worth $2,900, which doesn't sound too bad, except for the fact that when you account for inflation, your $1,000 is actually only worth $950. In other words, the real return, that's the jargon for this, the real return was negative. You actually lost money when you looked at the buying power of your money by buying the index and staying the course. And in almost any other circumstance,
let's just run this.
I would say
run this by us again. Over 16 years, if you'd put on day one, and that would have been in February 1966, you'd put $1,000 into the market and you just left it there. It would have tripled in value, but because of inflation, was worth less by the end in real terms than what you put in 16 years ago. That's disastrous. How could you have done better?
If you had just done a debit order, you just said, I'm going to take $100 a month. I'm just going to put it, a debit order off my bank account into the very same investment. So you're putting it into the index, nothing different, but I'm just going to keep investing, and I'm going to ignore all the panic, all the bad news, all of the dinner table conversations. I'm just going to keep going. I'm not going to try and second guess what the markets are going to do. I'm just going to do my simple strategy and control this, which is, simple. I'll just do it and ignore everyone else and not pull anything out and not be fancy. But by the end of that period, you would have actually, in cash, you would have put in $20,100. That's the amount of money you would have put in. And over that time, your $20,100 would have grown to $41,000 and some change, which sounds amazing, because, much better than $1,000 goes to $2,900. But once you account for inflation, you have made money. Your $20,100 after inflation has grown to $20,931. And I know you're going to tell me, Bruce, that's not great.
It's not great, Warren.
But doing something relatively simple, staying invested, and then just keeping your investment going. In other words, keep investing with all the bad news that's going on. I wasn't alive in the late 60s or the very early 70s, but from what I read in textbooks, wasn't a great time in the state of the world. Lots of fear around, and Cuban Missile Crisis and Cold Wars and Vietnam and all of that stuff. And you actually preserved the money. You actually protected the value of your money in real terms, the buying power of your money, doing nothing complicated, doing something very simple, but by just staying invested, but more importantly, to keep investing, to keep buying when everyone else is sitting on the sidelines, everyone else is panicking, and you simply have to do nothing unusual, nothing strange, just keep going.
Again, this is unfair because I don't think you've done the calculation, but I wonder if it would be different had you invested in the best 16-year period in history and you'd done exactly the same thing. You put in $1,000 and you'd watched and you'd at the beginning and you'd allowed that $1,000 to make money babies and to reinvest the dividends and to compound year on year on year in the best period in history, whether or not it would have been better to do the lump sum or to invest consistently through that same period.
You are absolutely right. A lump sum would have done better, no question. So when the lump sum investing works is when markets are rising consistently. However, we're not sitting in one of those times, Bruce. We need strategies to help people remain calm when everyone else around them is freaking out and panicking and just getting really uncomfortable and super despondent, both about South Africa and the state of the world. And this is not one of those periods of the best of times. This is kind of a lousy time, to be honest, and a frightening time. So you're right. I mean, I think if you're fairly confident that the world markets are going to run up in a fairly consistent pattern for month after month for a long period of time, then a lump sum would be your best bet always. That's no question. The problem is we don't even know what's going to happen in 5 days' time. Forget about what's going to happen for the next 16 years.
No, exactly
and then
right.
I would say,
and I, there is no uninterrupted period of gains over 16 years. There are periods in that 16 years where times are absolutely atrocious. There are times when they're absolutely euphoric, and somehow you have to hit a happy medium. And the best way to hit the happy medium is to be small, consistent, and committed, and just to simply keep on keeping on.
Exactly right, and I think it's not. I don't want to say it's not difficult. It's definitely difficult. Not practically. I mean, it's what we're talking about here is the simplest thing in the world. Start a debit order. There is no complexity in that whatsoever. However, when the news flow is scary, it becomes really hard to just keep going. And I think that's the message here is, simple things. I know they're not always easy to do, but it is the tool that we have as private investors, is we can look at the world and say, well, we don't want to keep repeating the mistakes that everyone else keeps consistently making decade after decade. We're just going to, we're going to do us. And to do us is we're going to be simple. We're going to stick to a very basic strategy, and watch the space. We might not do incredibly well when the world does incredibly well, but we really won't do badly in a time like that. However, when the world is falling apart, we're still going to be okay. And I think that's the key here is how do you eliminate the worst mistakes and how do you protect yourself in the worst of times and then participate, reasonably well in most of the upside when the world is going very well. I mean, I don't think I would mind too much if my money went from 1,000 to 9,900 and it didn't quite match the 1,000 to 12,000.
Sure.
That's okay. I don't mind a little bit of lost growth. but I really don't like losing money forever. That would really bother me.
Absolutely right. A lovely mail from Pam asking an incredibly pertinent and important question, Warren. And that is, my husband and I'm correcting the grammatical error. Me and my husband. No, my husband and I are at the point in our lives where we are looking for a financial advisor to help us plan for retirement. Point number one, Warren, that should have happened 20 years ago. But you're making a good call to get some help now, which is better late than never. It seems like you get good advisors and bad advisors. Absolutely. You get good financial advisors and bad financial advisors, good doctors and bad doctors, good lawyers and bad lawyers. You get good journalists and bad journalists. We can carry on, but most certainly you do get bad advisors. Are there any questions that you would ask to help you tell the difference? Are there any red flags that you should look out for as you go through the process of canvassing financial advisors? What a great question, Pam. Thank you. Warren?
I think it's true. I think there are some nice, clear questions you can ask, and for me, the first one, which is always uncomfortable, but it's a good uncomfortable question to ask, is how do you charge? How do you get paid? And what you're looking for, Pam, is you want firstly complete transparency and just complete openness from the advisor to say, well, I charge you an hourly fee and I'm going to invoice you, and this is how you're going to pay me, or I earn a percentage of the assets under the advice. So, here's a concrete example. If you give me, X million rand, I'm going to earn, however many hundreds or thousands of rands a month from your investment, and or I'm going to earn commission from the investments that I sell you. And again, if you put in your 100,000 rand as an investment, this is how much commission in rand terms I'm going to make. It needs to be very simple, very transparent. The advisor needs to have that information either at his or her fingertips, or very quickly be able to commit it in writing to you to explain to you exactly in terms that are very simple for you to understand.
And here's my follow-up question to that, and it's how do I assess whether or not it is a fair price or not? If I'm going to go buy myself a second-hand car, I can go on the internet and I can easily assess that the 1996 Toyota Taz, red with 5 scrapes on the doors, is 20,000 rand, or whatever the price of a Taz is. I can get to a price. How do I know when I'm sitting across the road across the table from a slick financial advisor who's been asked this question and has practiced the answer many, many times before, that what they're offering to me is going to be good value? Because that is a critical part of that question.
It is. It ties into my second comment is that you need to do this at least 3 times over. In other words, you need to go and speak to at least 3 advisors. You have to shop around for this. You can't just go to the first one that comes knocking on your door, or the first website that you find. And what I think will happen there, and I'm not dodging the answer. I'll give you an answer now, Bruce. Sure. But I think what will happen is, if you talk to 3 advisors about your situation and you get 3 answers to the how do you charge question, and then from them how they're going to charge you, very quickly you'll get a good sense of what's happening and what they're going to charge you. And the reason why I can't give a really straightforward answer is, if Pam's kind of financial position is, a mess. I'm not saying that she might not be in a good financial position, but just that her investments are all over the place and very hard to find records, and doesn't quite know what her expenses are, and her overall retirement planning is really messy to sort out. It might require quite a bit of work, whereas someone else might be absolutely slick and clean in terms of their planning and very simple, and so they might require very little work to kind of set a retirement plan for them. So there will be different clients with different positions requiring different levels of advice, and so to say that I think let's say 5,000 rand is a good fee for a retirement plan, that might be completely misleading for someone who's got a really messy position. Equally, if someone charges an annual fee, an ongoing advice fee that's linked to the size of the assets, I think that fee to me should range from about 0.5% a year to 1%. But again, it does depend on the work required on an ongoing basis definitely on size of assets, and definitely almost a fair use policy as well. How much work is involved in building the investment, maintaining the client to stay invested. All of those things are going to be quite variable.
And just because you're getting charged a particular percentage in year one, the complicated year, the year in which the assets are being sorted out and sifted and found and identified and right-sized and fixed and sold and bought and worked out, just because you're paying, that full 1% in year one doesn't necessarily mean you should be paying that same rate in year 2 to 5 to 10. Because surely all the hard work was done in year one, unless the financial advisor says, actually, you do need to keep paying me at this rate for 10 years. I anticipate you'll pay me for 10 years because I'm doing, 100 hours of work on your portfolio over here. And somebody, I can either charge you up front or we can do this over an extended period of time.
Yeah, I tend to feel that a great plan, a great documented retirement plan is fairly worthless if it's not implemented, firstly, and secondly, if it's not stuck to in bad times. So I wouldn't give a huge value to a beautiful document that's absolutely brilliantly designed and really complicated. If you know that the person on the other side of the table is not going to stick to the plan, by year 3 when the markets fall apart and they don't have the emotional fortitude to get through those bad times. So I think it's a bit like going to doctors. We only go to doctors when we're sick. I'd love to find a doctor who says, I'm going to charge you a monthly fee to keep you healthy. So I think most of the work in financial planning, if you've got a good person, a good investment planner, that they should be charging you a monthly fee to keep you going on your chosen path and to keep you from making bad mistakes and to keep coaching you. So I'm going to, for the first time ever, Bruce, disagree with you on air. But I think good advisors should be paid monthly and not too much upfront, actually. And then I think everyone wins over the next 20, 30 years of that relationship.
Can I just say on behalf of everybody listening to The Money Show this evening how much we're going to miss you, Warren?
I have one really big question that you have to ask, and that's about the education and experience. And really key to me, and I know I might be biased in this, is great advisors are called certified financial planners. It's an academic qualification. I didn't hear you.
CFA. So we've got a bit of a disruption on the line tonight.
CFP, Certified Financial Planner.
There we go.
And certified financial planners, I think, are what you know from that is the person's got at least a postgraduate qualification in financial planning, and they've got a certain amount of experience, and they've got a requirement to stay educated about financial planning on an ongoing basis, and they meet an ethical standard, and it's all done by an independent institution called the Financial Planning Institute. So to me, that's really key in this whole conversation is your advisor a certified financial planner? If not, why not? That might be a red flag for me. I know there are good advisors who aren't CFPs and they would sound biased, but I think it's a key reason. I think, you don't go to lawyers who haven't studied law, and you don't go to accountants who haven't studied accounting. I think the same applies here. And
also make blooming sure that they're registered as a financial services provider with the regulators at the Reserve Bank.
At the FSCA, definitely, and then also just another question will be, what products do you recommend? Are you restricted in terms of only advising on one company's products? If I come to you, will you only sell me your employer's products, or will you sell me the thing that might suit me better from somewhere else? I'm not sure that that's always a red flag, but it's a very good question to ask, because sometimes you might be stuck in one company that doesn't have the full suite of investment products that are well priced, etc., and that might be to your detriment. But it needs to just be clear and explained to you in terms of what's available to you. And then, this is your retirement planning. So the last thing to ask the advisor is, I would like to speak to 3 of your clients. I would like their names. I'll give them a call, and I want, proper references about you. And especially key there is, what did you do up front? What did you promise up front? And what's been delivered over the next number of years? And to me, those are great questions to ask the clients of the advisor.
Brilliant, brilliant, brilliant. Thank you, Warren Ingram, very much. Look forward to chatting to you next week. And Warren is a personal financial advisor, and he's a director at Galileo Capital.